Good morning, and thanks for joining us for the Investing Beyond Tokens, Unique Investing Opportunities in Digital Assets. Before we get started, I'm going to read a quick compliance disclaimer. Bear with me, guys, and put it up on the screen. This commentary is provided as general information only and is no way intended as investment advice, investment research, legal advice, tax advice, a research report, or a recommendation. The rest of it you can read later, but that's all we have to read at the moment. And now also, there's a Q&A feature. Please feel free to submit your questions during the webinar. If I think they're apropos to what we're talking about, I'll pull them up then, or we can have a little Q&A at the end. So feel free to use the Q&A feature. Now, gentlemen, if you can please introduce yourselves. I'm going to start with Ari Paul from Blocktower.
Sure. I'm not a big fan of long intros, so I'll keep it very brief. I'm Ari Paul, CIO of Blocktower. We're an RIA US-based asset manager. And in a prior life, I was a portfolio manager at the U Chicago Endowment and a option market maker before that.
Thanks, Ari. Steve, tell us a little bit about yourself.
I'll try to match the brevity. Steve Kurz, I lead the global asset management business for Galaxy Digital. We're a large infrastructure company with 500 people, publicly traded stock in Canada. The asset management business is one of our three businesses, and we run $10 billion of AUM across passive, active, opportunistic, and venture buckets.
Fantastic. Jeff, bring us home.
Sure. Hello, everyone. Jeff Dorman, Chief Investment Officer at Arca, along with my colleague, Rain Steinberg. We run multiple fund strategies, all dedicated to digital assets. And prior to starting Arca 6 years ago, long career in traditional finance at investment banks like Lehman Brothers and Merrill Lynch, as well as hedge funds like Citadel.
Thanks, Jeff. And yeah, it's probably a good idea to give a brief introduction for those that don't know me. I'm Jeff's colleague, CEO and co-founder here at Arca. As he said, an institutional asset manager with several products in the space. Prior to this, I co-founded the exchange-traded fund company WisdomTree. All right, guys, exciting day to have such a call. Let's start off with things in the crypto market that excite you, that you're seeing. And on a day like this, what's exciting? And then more broadly, what do you see that's exciting in the future? You want to start, Ari?
Sure. It's funny you said on a day like today, what I'm about to talk about is definitely not one of the sexier trading themes. It's not the thing where we get kind of the absolute insane 20Xs. And real world assets, which is kind of a term of art within crypto today for tokenizing anything that has a real world existence. So whether it's real estate, treasury bonds, corporate bonds, anything that isn't native on a blockchain. So a giant category that almost hides all the critical differences, whether you're tokenizing art or T-bills or anything like that. So have been very excited about this for 2 to 3 years, really. Existentially been excited about it forever, but a couple of years ago, it looked like we were kind of at that inflection point where the basic infrastructure was in place, the right people were starting to work on it. So over the last 2 years, we've seen that grow from almost zero in TVL to, it's very hard to, the numbers I'm going to throw out are very up in the air because even defining the category stuff. So take this as directional. You could say something like 20 billion in TVL today, and we're pretty confident that's probably going to 10x again over the next 2 years. There's a very kind of clear path. So like Blocktower ourselves, we've tokenized something like $1.7 billion of bonds. And we did that largely working with MakerDAO, where mostly a proof of concept, frankly. We tokenized T-bills to then serve as collateral within the decentralized stablecoin ecosystem. I say proof of concept because those tokens are not freely transferable. They're not permissionless due to compliance concerns. So we were kind of just moving the ball forward a little bit on one piece of the critical stack. Point is, it's early days. We're figuring out the compliance frameworks, the tech stack. I think the way I'd frame the opportunity as I see it is this is definitely a longer time frame opportunity. This is not a momentum trade. This is not betting on a sexy token. This is really kind of a true fundamental value creation theme. So there's a handful of live crypto projects that service this theme in different ways, whether it's a base protocol like Maker in some ways benefits from this by harvesting the yields. You have platforms like Centrifuge and Maple, but I'm not pitching you on any specific asset. The reality is this is fundamental disruption to core elements of the Wall Street model. So I won't monologue about this for long, but kind of the 30-second summary is, I think this problem gets solved and value gets created from two directions. What we're seeing today is largely from the crypto side. So it's tokenizing assets to solve a problem for crypto native people. In this case, the example I gave was, how do we get T-bill collateral into a decentralized DeFi system? The far larger market is coming from the other side, which is right now, for like, I used to be a treasury bond trader on the TradFi side, and a common thing is you never know who owns what treasury bond. The regulators don't know, the central banks don't know. We get what's called cascading failures to deliver, where Goldman Sachs defaults on a trade with Credit Suisse every day because their back offices have a minor administrative mistake. Basically what happens is you have a single bond that gets rehypothecated and traded 10 times in a day. Someone loses track of it, right? There's a minor human error. You then get a massive kind of administrative headache. It doesn't turn into a legal problem because these companies, they don't sue each other just because they're in technical default, but it's a huge back office inefficiency. It also means regulators tear their hair out when they're trying to pursue insider trading cases. So from that end, everyone sees the writing on the wall. BlackRock, JP Morgan, they all know that most things are going to be tokenized in a decade, partly because regulators are going to require it, because you can embed compliance within the token itself. You can have total real-time transparency. We also estimate the piece we've focused most on at Blocktower is the credit side. We think there's probably 50 to 150 basis points of cost savings, depending on kind of the market, just by eliminating a lot of back and middle office inefficiencies. That's going to play out slowly, right? That's kind of I'm viewing that as a 5 to 10 year disruption. So I don't want to, I'll pause there, but very exciting.
Thanks. And we have a hand raised. The gentleman or a lady raising your hand, please submit the questions in the Q&A box, and we can get them when calling on hand raised. Steve, what excites you?
Yeah, well, so why don't I answer it briefly, but through the lens of so the 4 boxes within asset management that we talked about: passive, active, venture, and opportunistic. This is more of a sort of market ecosystem and where are we point. In each of those boxes, you're seeing profound opportunities and interesting things that are unfolding that didn't exist 2 or 3 years ago. So even in the passive bucket, where you have something as simple as the Bitcoin ETF, soon to be, hopefully, we can talk about this, the Ethereum ETF, the building blocks of every large asset manager in the race writing about crypto, writing about allocation frameworks equals the beginning of this becoming an asset class. Everyone's talked about that for 6 years. That talk is meaningless relative to what's happening right now. And so 3, 4, 5 years from now, those seeds are planted. That's exciting. When you move to the active side of the business, you look at the accordion of investable products, and it's just dramatically different, right? You have stocks that relate to crypto and blockchain. You have bonds. You have ETPs that are global, not just in the US. You have coins that are qualified custodian coins that can go into RIAs, and so that accordion allows you to do a lot more from a product perspective, and that also speaks to the evolution of the asset class and the development, the regulatory pieces as well. On the venture side, we have a venture franchise, and it's actually very similar to what Ari was mentioning. We have a number of themes. Probably the biggest theme in terms of TAM is just financialized applications. Finance is better on a blockchain, and Ari gave a great example of why that is. And it's not just cutting the spread out or the 150 bips. It's the timing. It's the ability to embed AML KYC. And so there's all kinds of early stage investments that not over 10 years, but over 3, 4, 5 years can actually start to really stick and make changes to the traditional world. Payment infrastructure, it's DEX volumes. So there's so many sub themes within that financialized application piece that we're excited about investing in. And then the final bucket is sort of this opportunistic bucket. The fact is, you had multiple crypto cycles over the last 15 years. Only in the last 2 years did you have a cycle that looked pretty similar to what a traditional cycle looks like. Bankruptcies that work out some of the problems, secondaries when you have weak holders, a real growth equity opportunity. There's actually dozens of companies that are of a certain size where you can have that growth equity secondary discussion. That's different, and it signals a much more mature space than the bear cycle before it. So I think across all aspects, for different reasons that are somewhat related, we're excited.
Fantastic. Jeff, get you up in the morning.
My children. I think, it's interesting just hearing those last 2 answers, because, there's been a lot of attention, obviously, on Bitcoin and on the ETF. And immediately you ask what excites us, and all of us are talking about all these different areas that blockchain is impacting. And I appreciated really what Ari had said, in the sense that most people listening to this, I assume, have an investment bent. They're trying to figure out ways to profit in some way off of blockchain success. And what Ari's talking about is huge. It's a massive opportunity, but it's not the sexy investment that anyone's going to like make a ton of money off of today, but it's probably the most important. What's always concerned me about blockchain and crypto being real-time prices is always that the ability to make money on the investments has oftentimes gotten ahead of the actual growth and traction of what blockchain can really do. But we're starting to see the opposite happen now, where in some cases prices are lagging how much traction there actually is, not just from real world assets like Ari mentioned, but you're seeing areas in DeFi that have now been around for 4 or 5 years, are battle tested, have absolutely outperformed their centralized competitors in terms of lending and exchange trading, especially through bear markets and through bankruptcies. But the tokens have not caught up with that, right? And then we're also seeing new sectors and emerging areas like the intersection of AI and crypto and DePIN, decentralized physical infrastructure networks, where you have real companies using blockchain and crypto as an incentive mechanism. Things like Hive Mapper, which is basically rebuilding Google Maps from scratch by incentivizing people to map the world, or Helium, right, using crypto to incentivize people to build out a mobile network. So that's what really excites me is that, 6 years ago when we started Arca, it was like, there has to be something besides Bitcoin. Look at all these forks of Bitcoin, like Bitcoin Cash and Litecoin. And of course, now those are all irrelevant. But slowly it was the rise of stablecoins and DeFi and NFTs. And now it's the rise of AI and DePIN and data availability in layer twos. And you're seeing all of these areas of growth and the evolution of digital assets where really any sort of a passive investment just cannot keep pace with the growth and the evolution of these different sectors and areas of focus. So it's a huge industry right now, and it's impossible for one person or even a small team to keep up with all of it, because it really is penetrating everything from debt and equities and bankruptcies and from asset-backed tokens to pass-through tokens to currencies. So it's growing tremendously, and to be able to sit here on this call and focus on these areas that maybe are not what you hear about in the news and are going up 4,000% in a day is what gets me up in the morning and excites me.
Awesome. I think all the dispersion of answers there really demonstrates just the breadth of things going on in this space, and maybe a good segue to this idea of, we all have the three institutions on here, active offerings, and Jeff touched on it. What do you see as the benefits of active management? I come from a passive background. I started an ETF company and initially started to address the digital assets space in 2017 with the idea of a passive index that very quickly became out of date. I'm talking my index that I created was out of date in a month because certain very relevant things weren't invented yet when I created it, and that's the speed that's going on here. And it made me think about active here. But I wonder how you gentlemen think about it. Steve, let's dig into how Galaxy thinks about active management, the benefits.
Well, I think maybe we can start with what we've learned, because I think there this, and this is a crypto point, but it's also an active management point in crypto. We all on some level feel like we've seen the future, and we're biased because we're in crypto, and so everything's going to look very similar. And so the crypto world raced to have, and we all were part of this, and it's logical, right? There's the liquid venture fund, there's the market neutral funds, and all of those things made a lot of sense. When you look back on the last cycle, it's very clear that those ideas and the things that were prerequisites to those ideas being scalable, having persistent and repeatable alpha, and really making sense for how the world engages with active funds, we were just ahead of ourselves. And so it's a truism at this point that the two pillars of crypto historically in asset management, at least, have been venture and passive. And then we've been sort of slogging through the mud of what's the art of the possible in an RIA framework, with qualified custody, not taking crazy back-end risks to the products. Really, the product design has been the hardest part. I think any one of us could have our teams go and spin up an on-chain strategy that we think, was alpha generative and made sense. But when you're trying to engage with the institutional world, which we are, and you're trying to engage with the regulatory world, which we are, you have this Venn diagram that at least 2-3 years ago was narrow, and we were all trying to live within that and demonstrate alpha. What's happening, to my earlier point, is not only is there a learning from that and understanding being brought to today's product development, there's also an expanding toolkit and an expanding awareness from investors about what crypto is and isn't. And so I actually think this is the beginning of a multi-year renaissance for crypto asset management. I really do. I think the next 3, 4, 5 years are going to be tens of billions of dollars of AUM, and not the handful of billion of AUM that has been a survivor mode, really. Like, if you made it through, and all these firms have, the last 2 cycles as an active manager, you must be good at risk management. You must have avoided some of the very obvious things that have caused many others to go bankrupt. And so that says something, but that's not the same as delivering, what people expect in an active return portfolio generally, which is, uncorrelated returns, lower volatility, diversification. And the promise of that is certainly there from crypto. But I think the conversation has to start with being honest about what's possible today, what strategies are interesting. Like, market neutral is going to be a real thing in crypto. It's probably a few years away before you can say you have a $500 million truly market neutral fund that operates within regulated rails. And so for us at Galaxy, we've kept it pretty simple. We've had a long only coin picker fund. That's our lane for now. We're exploring an absolute return fund that has a lower vol profile, like equity funds, that uses that full toolkit, and really keep it simple and grow into that and follow the path has been our approach. But I'm curious what our peers here have to say. That's kind of our take today.
Mr. Dorman, what do you think?
Yeah, I mean, first and foremost, I already mentioned the evolution of the asset class, and within a month of a passive portfolio, it's probably obsolete because this industry just grows and changes so fast. So I think, just by definition, active is going to outperform passive for a long time, right? I mean, at some point it will look just like the traditional debt and equity markets, where passive outperforms active. But I think we're a decade away from that, just given the speed and the evolution and the growth of not just the industries, but the way the tokens are evolving and all the different areas of impact. But I think, even more than that is just the flexibility of what active management offers right now in this industry. I mean, just by the nature of even the first slide we showed here was just the disclaimers and traditional finance is moving into digital assets in one way or another. It's not just picking a few tokens and seeing where they are in 7 years anymore. As Steve already mentioned, there's been a slew of bankruptcies, and those have been amazing opportunities, from the FTX estate to the Celsius estate, to some one-off areas here and there. There's also the public markets now with everything from MicroStrategy and Coinbase and Galaxy stock, to some of the convertible bonds that have been issued, to the mining stocks. There's been a ton of governance opportunities. I'll use the word activist loosely, but there's been plenty of opportunities where token prices have been trading at 20 or 30% of the book value of the cash on the balance sheet of these entities, and being able to identify that and extract that value is something that wouldn't show up on a passive index or a screener. And even just some of the events and catalysts. This is still an industry that does not have Reg FD, right? There's no standardized reporting. There's no automatic 10Ks and Qs and 8Ks and fair disclosure. I mean, you look at the NVIDIA conference this week, for example, like every single equity analyst, and specifically tech and AI analysts, are on that NVIDIA conference listening. Whereas information in crypto might come out on an AMA at 2 in the morning, and you might not see it for 2 days. So the ability to be able to extract that information and react to news and events and catalysts and upgrades and software changes and tokenomics changes, it's just a huge opportunity set that is quite unparalleled, really, in terms of other markets where active really has all these different opportunities relative to a passive investment set.
Ari, how do you think about the benefits at Blocktower?
I certainly agree with these gentlemen. I'm going to probably say very similar things, just with a slightly different kind of mental model. So there's this incredible almost paradox, which is, on the one hand, these are by far the most inefficient markets that I had ever seen as a trader and investor, almost comical. So as an example, just a couple of weeks ago, the effectively risk-free rate in crypto was arguably like 30%. So CME, you could have locked in on the CME, an annualized future rate in the high teens, so something like 18%. But you could have done collateralized loans to OTC desks at 30% that are fully collateralized. You could have done on Deribit a pretty high quality offshore exchange, definitely not the CME, but there you could have been lending out instantly callable Bitcoin with a 0 time frame loan at 60%, averaging over the last 3 weeks. So on the one hand, we have these incredible opportunities, even for simple basis, things like the GBDC trade last year, where GBDC was trading at a 50%. And that ties in very direct. I'll use GBDC as an example, talking about active versus passive. So the paradox is incredibly inefficient market. There's free money falling from heaven in airdrops and yield farming and CME basis. And yet, Jeff, I don't remember exactly when you launched Arca, but I think we launched around, at least in the same year. But basically there were, Jeff and I and Steve, we had 300 investment colleagues from 2017. 295 of them went out of business. The vast majority of prop traders, investors have underperformed any relevant benchmark after fees. Well, what explains that? I, as CIO Blocktower, literally 50% of my time or less is spent on what you would normally think of as investing and trading. So markets, assessing assets. The other half is counterparty risk, smart contract risk, legal and compliance. So on the counterparty, it's like, okay, there's this free ARB available on an exchange, but my regulator is telling me that exchange is a criminal enterprise and they're currently being sued. And that applies even to Coinbase, right? So I'm not saying we need to, that we need to be stressing about underwriting Coinbase, but worth noting that even Coinbase, our regulator is telling us they're an active criminal enterprise and we may be taking legal risk by exposing fiduciary assets to them. That's not a risk I'm worried about, but the point is that is a risk for most exchanges in crypto, especially the ones that have more liquidity. So all of that stuff explains the gap, right? It's how is it that so many people have been net losers in crypto despite the easy trading and the tailwinds? It's they lost to the hacks, they lost to the thefts, they lost to the regulatory shutdowns and fines and fees. So I think passive is really difficult to pull off in a responsible way in crypto, right? What does passive mean? Well, in traditional finance, I'm a believer in passive. I come to this really from I was at the University of Chicago Endowment as an investor. And so my whole framing is really from that LP perspective of, LP shouldn't be paying fees for nothing. But what does passive mean? Well, it's not passive management if the manager is simply failing to underwrite a critical risk, right? If for example, was GBDC passive investment in Bitcoin? A lot of people thought it was. A lot of people marketed it as that. And then that produced a 50% crash relative to Bitcoin. I mean, think about that. You thought you were passively investing in Bitcoin and you got a 50% loss that didn't have to ever mean revert. That wasn't guaranteed. So I think there's very little that you can actually do passively in crypto today in a literal passive sense where you're not making aggressive credit bets on counterparties or aggressive tech bets on smart contract or protocol risk. Basically, if you cold store Bitcoin, that's the passive version. Anything beyond that, you're engaging in either active asset selection that is very different from, there is no S&P 500 of crypto. We don't know what assets are going to exist in 5 years. We don't know. So that distinction in traditional finance for an asset to become a public equity on the NYSE, it's a pretty mature asset at that point, right? It's probably been around for a decade. It probably has customer bases and proven product market fit and working products. Whereas in crypto, we have assets that become top 10 market cap assets with $20 billion market caps that get put in every index that are effectively pre-product, right? Sometimes that literally happens before the protocol has even launched. There is no product. There's nothing. You have 10 billion. So what does it mean to passively invest in an index of assets like that? It's not really passive, right? You're just kind of making a very aggressive active bet on someone else's index creation or on the counterparty risk. So with all that said, where I come out is what I recommend to people is absolutely look at passive, but treat it, but really be passive, meaning cold store Bitcoin basically. And if you're going to use a custodian, underwrite the custodian thoroughly because there's no third party that's ever done that in a way that you can just kind of use their homework. Otherwise, as Jeff and Steve noted, there is this incredible opportunity set on the active side. Most fund managers have failed to capture it. I think the ratio will improve. We're getting more and more professionals, fund managers, experienced, gray-haired, right? The average fund manager in 2017 was a 25-year-old in a hoodie in his mom's basement. Today, we're getting much more professional management. So I do think the ratio will improve, but underwrite the manager carefully.
Yeah, and I also think I just, real quick on that end too. I mean, you hit on the risk management about before you even get to the investments. I remember, you all hear those saying like two guys in a Bloomberg, right? Like how easy it is to set up a hedge fund in the traditional world. You just have, two people, a Bloomberg, and immediately you're just like, oh, I'll take any prime broker, I'll take any custodian. They're all the same. They've been around for 100 years. It's an afterthought, right? Maybe once every 2 years, a new service provider comes into your office just to say hello, shake your hand, and take you to dinner, even though there's a 0% chance you're ever going to switch because there's no value add. Whereas here, the amount of underwriting, as Ari said, the amount of time and energy spent on setting up exchanges and really figuring out who the custodians are, who the exchanges are, who the OTC partners are, where you can do business, where you can leave assets, what risk metrics you're going to have in terms of how much you're going to leave on any venue or any exchange or in any wallet relative to how much you need to trade versus the security and the custody of the assets. It's a full-time job for a huge team. And that is not the case in the traditional world. And it really is creating a barrier to entry for a lot of firms. As Ari mentioned, like we started around the same time, around 2018. When we first started, I was like, this is a huge white space, but it'll be closed really soon. It hasn't closed at all. In fact, it's widened. I mean, there has been way more people and teams leaving than there have been entrants. So those who are still doing it and have gone through that process, and that understanding that risk management, again, happens long before you even make your first investment, is a huge reason why, again, loosely using the words active versus passive, but why there's quite a bit of advantage here for the firms that are trying to set themselves up for the evolution and the growth of this industry.
Yeah, and I would briefly add, I don't want to beat the whole thing to death, but I would add that if you haven't made an allocation yet, and maybe it seems self-serving given the three of us, but even if it's away from the three of these institutions, I really think there's value to a crypto native firm that has traditional DNA that's gone through one or two cycles. Both the crypto, to Jeff's point, I think there's actually more funds that are going to go out of business. A lot of crypto native funds that may have been very, very intelligent are maybe they did the liquid crypto venture fund and they're trying to make their way to the high water mark, and that's not going to work itself out. And so there's still this turnover that's happening. And then on the other side, there's going to be a lot of talent that comes in that's going to be the traditional world talent, the gray hair. But I just don't think you can substitute the knowledge and experience of banging your head against a wall the way we have for 6 years and knowing exactly where the pain points are and are not. And so that means something right now. So that would be point one. And then point two, to Ari's point, look, we have a multi-billion-dollar passive business. So I don't disagree entirely with him. The way that we've been able to do that, for instance, when you build the Bloomberg Galaxy Crypto Index, you have to be very active with your index construction and with the management of the index along the way. And you have to have a committee that actually kicks things out for very specific reasons. For instance, when the Ripple Christmas case happened a few years back, we made a decision with Bloomberg to kick that out of the index. And that's really difficult. And you don't really get paid enough to do that. And this because the scale isn't there yet. And so it's a labor of love to have that business. But what we've done in the meantime is we built a number of partnerships with large institutions to launch ETFs that can scale. And so there's a way to do it, but it's not as simple as, hey, let's go build an index and scale it to 8 billion. And it's going to sit in an ETF wrapper and be on brokerage accounts. It's much, 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 much more involved than that.
Great. All completely valid. And I think this next question, we have a question from a participant, is kind of indicative of the immaturity of just the active passive world. Have any of your active strategies actually outperformed just buying and holding BTC or ETH over a decent length of time, 2.5 plus years? And before I throw this to, let's say, Jeff, to start it off, this also just is indicative of how interesting. This is probably the only space in the world where a single product, either Bitcoin or ETH, is considered appropriate for holding as representative of the entire ecosystem. This is something that is, under 15 years old. We all love probably or have certain feelings about Bitcoin and ETH, but they didn't exist that long ago. It's not insane to think that they could not exist at some period of time, and that there are people that want to express their entire, exposure to this asset class through one or two things. And we run up against that a lot. How does your multi-product strategy perform against Bitcoin and ETH over a long period of time? Jeff, you want to just talk about that briefly?
Yeah, I mean, I have to be careful about return information specifically to
Yeah,
our
we won't get specific
compliance
there, but yeah.
but you know, the question is, there's really two questions in my opinion. The first is I'll answer the actual question, which is in our flagship fund, which has the longest track record, almost 6 years. That one we have not outperformed Bitcoin since inception, but there's been many rolling 2 and 3 year periods throughout that 6 years where we've outperformed by 6, 7, 800 basis points. And given that this is a liquid fund and investors can take their money in and out as they please on a 30-day window, there's plenty of LPs who have materially outperformed Bitcoin over the time period that they've invested. But the real question is, why are we comparing to Bitcoin in the first place? And I think that's where it gets really interesting. Like, you know, for instance, I would consider myself essentially the equivalent of a long short equity manager, I guess, in the digital asset world, right? I mean, effectively, we're looking at all of these different tokens in different sectors, pretty sector agnostic, blockchain agnostic, token agnostic, and looking for ways to create returns. But every time I go on CNBC or on Bloomberg, they ask me about Bitcoin, right? And every time we talk to an investor, they ask about Bitcoin. I'm like, well, I've seen tons of long short equity managers and nobody asked them about gold. Like you would ask them about their expertise. My expertise is not Bitcoin, right? I assume that every investor who invests in our funds already owns Bitcoin and they're not looking for Bitcoin exposure. They're looking for exposure to the other areas. So I think the question is, I'm not going to say the question is wrong. I think it's just flawed in the sense that I don't think that's the majority of goals of the digital asset active managed investment space is to outperform Bitcoin. I think the goal is to pick a benchmark that is more appropriate based on the risks and the rewards that we're going for. And in that case, we've outperformed all of those benchmarks, right? In addition to the Bloomberg Galaxy Crypto Index, there's, you know, the S&P X Mega Cap Index. There's a lot of indexes that are not 80, 90, 100% weighted to Bitcoin that I think are more relevant to a strategy for investors who want actual exposure to other areas of blockchain's growth.
Either of you gentlemen want to add anything to that?
I'll add, let's see. So it's similar to Jeff, a little awkward talking about exact performance and in fund structure can be a little challenging with different entrants and exits, side pockets, all that. Yep. I think my main takeaway though, like not trying to dodge, I mean, so I am kind of dodging the question in a direct sense, but to talk about a little bit usefully, I found, so before fees and taxes, I found it to be relatively easy to outperform kind of all of that. After fees and taxes gets much harder. If you do the math, if you have an asset that 3x's, let's say over 3 years, well, if you're collecting carry, you need to generate a lot of alpha to make up for passive holding. And similarly, if there's any tax inefficiency at all, right, if you're going to be paying even long-term cap gains on a sale, well, that ends up adding up because you're talking about such giant moves on the beta that gets applied to. You need to make a lot of alpha to make up for that. Fully agree with Jeff's point. When we launched in 2017, everyone, of course, said, well, what's your benchmark? And what I said at the time was, I joked, we're going to be benchmarked with hindsight bias against whatever wins. If especially, I mean, we're in a little bit of a different world today, but I still think this is true. We don't know if Bitcoin's going to exist in 10 years. Like right now, it's very reasonable to use for a crypto investor who's looking for crypto exposure to treat Bitcoin as a benchmark. That's reasonable because Bitcoin is the majority of the market cap. It's the majority of the accessible liquidity. But will that be true in 3 years? You know, who knows? In my head, that's a little bit like treating NVIDIA as your benchmark. You know, that might be reasonable over a 3-month time frame if you were an active tech investor, maybe. I'm not even playing nowadays, but it's certainly not reasonable over a decade because if NVIDIA ends up falling 90% and if NVIDIA turns out, like a better analogy might be like Ask Jeeves, where Bitcoin in 10 years may look like Ask Jeeves and no investor is going to be impressed that you outperformed the down 100% and only lost 95. If Ethereum or Solana take over the world, everyone's going to say, well, how'd you do against Facebook? How'd you do against the thing that won? So I view part of basically choosing your benchmark is a very active decision in crypto that you kind of can't avoid. Bitcoin is a possible default decision, but that's a very active decision, as Jeff's saying, and it's not the right one for plenty of investors. Another thing to note is the diversity in fund management approaches. So in traditional finance, you know, you're comparing generally apples to apples. You've got 5 different S&P benchmark huggers. They're all claiming they add a few points of active alpha every year. you calculate Sharpe ratio, you look at tracking error. None of that really works in crypto because, for example, I may be running my book 150% levered long. Jeff may be running his in closer to absolute return kind of approach. We may both have very similar PPMs and fund docs that give us lots of discretion. And so it's very hard, right? How do you compare Jeff's performance to mine? You need a lot of transparency, right? Like I couldn't do it right now. I don't know enough about the risk Jeff took to if we had an LP in common and that LP said, Ari, how'd you do against Jeff? Here's his numbers. I wouldn't have any way to explain the difference, right? Maybe he was a much better investor than me. Maybe he took 10 times the risk and got lucky. So it's challenging. And I think as a allocator, it just means, there's homework to do to really being thoughtful and exploring the mandate. What, Arca, Blocktower, Galaxy, we all offer different products, different versions of long only crypto, different versions of not long only. So I think being critical at evaluating those, aligning those with your goals, with your risk tolerance. Where this sometimes goes wrong is unrealistic expectations. So for example, some fund managers in crypto will pitch, oh yeah, I can give you the upside and protect you from the downside, right? I can give you a 5x when Bitcoin gives you a 2x, and I can do it without taking the 80% drawdowns. As far as I know, no one has pulled that off in the last 7 years across 2 cycles. I'm not aware of anyone who's successfully really nailed it. So it's realistic to try. It's realistic to try to add value on every angle. But if an investor thinks they're getting, like a really common question I get is, Ari, you're obsessed with risk management. Tell me how you're managing the beta risk. And my answer is, well, I'm taking beta risk consciously. That's part of our mandate. Like if crypto goes to zero, we may not go to zero, but we're gonna, we're consciously taking that risk. So for me, a big part of the goal is communication with potential investors, making sure we're aligned on their goals, being realistic about what a mandate can hope to achieve even, and really make sure they're comfortable with the risks that are being taken on their behalf. Something that where this often goes wrong is, I'll give you an example with, for example, lending to Bitcoin miners. Nothing wrong with it in the abstract. A number of the entities doing it were not prepared to take possession of the equipment, for example, which is kind of like lending 101. Like if you're lending against collateral, you have to be professionally prepared to manage that. And so the investors in the strategies didn't really understand the default risk they were taking and the downside, because basically in a fire sale scenario, they weren't prepared to professionally manage the fire sale. And so you end up with a much worse economic outcome than the market risk suggests. Similar to someone who took a massive loss, which frankly, most of the industry, including my firm, have taken counterparty losses. But to not incorporate that into your thinking a priori means you're almost definitely going to be disappointed.
Yeah.
I try to think of active management as fully risk adjusting for all of these things as best we can.
Yeah, I mean, it's a similar thought, right? Like if you're an investor who only thinks that Bitcoin and ETH are equals crypto, or 95% of crypto, or the promise of crypto, or the return generative potential of crypto, you probably shouldn't be investing in an active crypto fund, right? You have to believe that there's a bigger story there than that. A couple quick points. We in our long only fund, we really call it risk managed crypto. It's not a hedge fund. It's more than Bitcoin and Ethereum, and it is using cash as a weapon to get out of the way. And so over the last 2 years, which is our track record, we have outperformed the Bloomberg Galaxy Crypto Index, but we've not outperformed Bitcoin, and we're unapologetic about that. I think the incentive, if you benchmark to Bitcoin, particularly in a mega cycle, or where there's a unique supply demand dynamic, or a catalyst for something like Bitcoin, you're creating an incentive where you're going to chase broadly the tail of crypto that you don't want to chase. You're going to have to take bets on altcoins. Maybe that's not even in the toolkit from a qualified custody perspective. So it really does get down to the expectations management and what you're willing to do and what you're not willing to do. I think most investors don't want to make a concentrated bet in crypto, and they want some degree of diversification. And the trade-off for that is you're not going to chase the fastest horse on the way up, and you're going to be comfortable with some living in the middle on that for a much better return stream that's durable and over time. The other point I would make on benchmarking, which I fully agree with, that when I was talking about the Bloomberg Galaxy Crypto Index, from day one, we had a cap on any asset, including Bitcoin and Ethereum. And that wasn't because we were trying to be cheeky about it. It was, you need a benchmark in place for there to be an asset class. And for there to be an asset class, it has to be representative of the growth of an asset class, of the accordion of those going from 1 to 2 to 10 assets that make sense. And so we like it as a benchmark because it allows for reasonable benchmarking for those that are not just focused on Bitcoin or Ethereum, and gives some level of consistency over time, and it's now been 6 years up and running. And so those are sort of our general thoughts. I also think when we move into a hedge fund, it'll be, if it's an absolute return, that's a ridiculous thought for us of chasing Bitcoin. That'll be targeting volatility, because that's where we think the investor base wants to be, or the investors that we're targeting that fund want to be. And so I really do think it comes down to the mechanics of the fund, why you created the fund, who's interested in that fund, and how you operate the fund.
Right.
And to both of your points real quick, I think the communication of what you're doing is the most important. I mean, 5 years ago, you guys all know this as well as we do. Most people who are investing just said, I don't know what this is. I just want exposure to crypto and we'll give you some money. They had no idea what else was out there. There was not a lot of thought being put into the different types of strategies. Now, the LP community is definitely getting much smarter about that, really understanding and looking into the differences and the nuances of different fund strategies. But alternatively, the people coming into the Bitcoin ETFs right now are probably back to where we were 6 years ago, in the sense that a lot of these FAs and RAs are just saying, I want crypto exposure. And I can tell you exactly right now what's going to happen. And at some point over the next 2 years, all of these new investors into Bitcoin via the ETF, at some point, there's going to be a period where crypto is flying and Bitcoin is either not or even is down, right? We're going to have a period where Bitcoin is down and everything else is up, or Bitcoin's flat and everything else is up. And they're all going to go to their advisor and say, I don't understand. I thought I was long crypto. They're like, no, you weren't long crypto. You were long Bitcoin, which is one very large asset within crypto, but one very small sliver of the overall opportunity set of crypto. And I think that is when you're really going to blow the doors open in terms of education of, oh, well, what else is out there? What do I really need to own to have actual full crypto exposure and not just single asset exposure?
One last point to add, there's increasingly a lot of money on the table that would be considered almost a fiduciary obligation to pick up. It's not quite there yet in crypto, because there are risks that require active underwriting around having these assets. So for example, imagine buying a corporate bond and just not picking up your yield, your coupons, right? You could do that as a speculative trade, but like, why, right? You're at such a disadvantage to the rest of the market. So that's already true for Ethereum, for example, where you have very close to a risk-free yield from staking Ethereum on the Ethereum protocol itself by LSDs. That is a layer of risk. It does require active underwriting at this stage by experts, but that's quickly kind of becoming passive, where if you're long ETH and you're not capturing that yield, it's starting to look like you're holding a corporate bond and just not capturing your coupons. So this comes in many forms. There is passive yield available on Bitcoin. That it basically along a risk curve, depending on how much counterparty risk you're willing to take. For things like Solana, there's pretty substantial value in airdrops, where if you don't have direct custody of your coins, or if you're not working with a custodian to access those, it's similar. You're just basically money is being handed to you that will go unclaimed and therefore ultimately destroyed. So I don't think we're at the point yet where it's like a fiduciary obligation to do that. There is a layer of risk that you have to underwrite, but yeah, worth noting that passive in crypto, basically, we don't have the infrastructure to support it. There is no prime brokerage. There is no security lending that's like blue chip and risk-free. So you're leaving potentially a lot of money on the table in the passive version. And that's probably going to get more and more extreme as time goes on, as we do build out kind of this cryptid native prime brokerage system that a couple of weeks ago was effectively offering you 30% just for having Bitcoin.
I think that's a really great point, Ari. And interesting on something you said earlier about in risk management, it means something way different in your seat. People think a lot about investment risk, but not a lot about counterparty, all the other things. What do institutional allocators, people that want exposure to this space, what should they be thinking about when they're looking at managers, about their due diligence practices with counterparties? You know, we talked a little bit about the survivorship bias in this space. Jeff, let's start with you on how I have a feeling you spent quite a bit of time early on in the counterparty due diligence and service provider world. How do you think about that in the risk management lens?
I mean, how do I think specifically about what the LPs should be looking at? Investors?
Yeah, kind of like LPs, they want to get exposure to the space. They're starting to, you know, like you say, there's going to be new managers. What do people need to know really about what, you know, the lack of prime brokerage, the risks that really aren't really native to them in the traditional world that kind of exist here that they should be aware of?
Yeah. I mean, I touched on this a little bit in the sense that like it's just an afterthought in the traditional debt and equity world, right? I mean, like, you know, almost all of the institutions you could partner with have been around for 100 years, right? Here you have, Coinbase and Galaxy as probably like the two biggest like stalwarts in the digital asset industry. And they're both what, 7, 8, 9 years old. I mean, there's just no track record. There's no history of expectation of perfection because it's all new and it's changing and there's real risk here. So, first and foremost, I think from an investor standpoint, I remember very early on, this is probably 2019, one pension fund who was doing due diligence on our funds came to us and said, we do diligence to 100 funds, and you are the only one that I would be comfortable bringing to investment committee. And at first I was like, that's great. Wow, look at us. We're doing great. And I was like, wait, that's actually terrible. 99 other funds didn't even have the ability to get to your investment committee because they didn't have basic building blocks of an asset management firm that would be required from a institutional investor's due diligence. So I think the first thing I would say to any investor looking at these funds is like, as Ari said, I mean, most of this asset class has become professionalized at this point. It's rare now to find the 24-year-old star trader who started a fund because, quite frankly, they're out of business because they didn't know how to appropriately underwrite and assess these risks like counterparty risk and custodian risk and all the different facets we've already touched on. So I'd say first and foremost, just if you're due diligencing a fund, I mean, the first thing you should do is ask for their DDQ. If you're talking to any fund that doesn't have a DDQ, just stop right there. There are a lot of professionalized funds now, most of which have some traditional finance experience, just because, as I always say, back in my debt and equity world, I traded every region of the world. I traded every asset class. I traded every sector. I knew how to be an asset manager and learned how to invest in these other areas. I think the same thing is true of digital assets. Like, we know how to be an asset manager. We understand compliance and fiduciary responsibility and risk management, and we're now applying it to digital assets versus somebody who is just coming up from digital assets, who might be the smartest person in the world at crypto, but doesn't know how to be a fiduciary of your money. And, what I call a lot of those first-time fund managers, I call them first-year analysts, because that's what they should be. They should be a first-year analyst at some other fund, not running a fund themselves. And that's not meant to, be negative or to desecrate anybody who's trying. It's just, you have to have this experience when you're talking about managing hundreds, if not billions of dollars of other people's money. So that would be the starting point for me, is understand who you're going with, what they've already done, because their DDQ will tell you, these are the custodians we use, these are the auditors we use, these are the fund administrators we use, these are the OTC counterparties we use, these are the exchanges we use, these are the risk metrics we have, here are the benchmarks we use. And it'll all be very spelled out. And then obviously they'll ask their own additional, custom questions as well. But again, the firm you work with should have a team capable of handling those questions. So to me, that's the starting point, and that'll be the most enlightening to anyone looking to get into the space through either an active or passively managed external fund manager.
I'm going to give a couple specific questions that I would suggest anyone listening to this ask any fund manager. One thing that's been kind of shocking to me is how few people in the crypto industry, in my head, it's about just a serious approach to investing trading. And I mean serious almost as a term of art. So if you're making an investment, any investment, you're looking at risk and reward. Right? I mean, that's simple. If you're investing in a yielding opportunity, what's the risk adjusted yield, right? What happens in crypto often is literally this mindless. People will look at two yield opportunities. They'll say this yields 12%, this yields 4%, the 12 is better. That would be the equivalent of a bond investor saying, oh, corporate bonds yield more than T-bills. Therefore, why would you ever want to own a T-bill? Right? Completely ignoring the risk side, the default side of the equation. So here's the questions I'd recommend asking a fund manager. And if they don't have, you should not expect a point answer. My own answer to these questions would be a winding long monologue, but they should have thought about it, right? There should be a thoughtful answer that reflects this is part of their daily investment process. So one, what annualized loss rate are you running from counterparty risk? Or if the fund manager is talking about a specific counterparty, you can ask that question, oh, you're on Coinbase. What is Coinbase's annual default risk in your assumptions? Now, I can give an answer to that question. I'm not saying it's a good answer, but at least I've thought about it. I'm shocked at how many fund managers just put zero thought into it. Same for DeFi risk. Oh, you're earning 30% for me yield farming in DeFi. Is that a risk adjusted 30%? Oh no, that's the headline. Well, what do you think the real yield is? Right? And an amateur might say, oh, well, it's less. I don't know how much less, but I think it's so good. right? They make no effort to quantify it. They don't even try to engage in a rigorous investment process. Another is, what is your and this one's a little bit more for private investments. What is your financial exposure to regulatory or compliance likely catalysts? So a lot of VCs have invested in things that are literal criminal enterprises, literally. I don't mean that as a moral judgment, just literally. So those companies won't ever exit unless something changes. There is no public listing. There is no normal acquisition because they are literally criminal business models. It's not that the teams are criminal and can be replaced. It's the business model. It's fundamentally illegal. So that doesn't make it a bad investment. Many disruptive business models, like, I mean, Uber broke every local ordinance. It moved fast and broke things. That was a successful investment. But again, there should be thoughtfulness behind it. If you're a VC investing in an outright illegal business model, what is your thought around the potential exit, right? You need to in some way incorporate that. So I would suggest, and then the last one, the fourth one is, and this is about how serious the team itself is taking their own continuity and survivability. What is your internal MMPI compliance program? So 2 years ago, most funds had none. There was no MMPI program at all. And that was kind of okay because we've had close to zero enforcement of insider trading in crypto. I'm not saying that'll change tomorrow because the SEC looks quite weak. They keep losing in court. They keep getting harangued by Congress, but that will change eventually. And funds that are engaging in insider trading extremely blatantly, leaving smoking guns all over the place, that's probably not indefinitely sustainable, especially if the person listening to this is an institutional allocator. Those funds will get regulator attention. They will get interviewed. They will get subpoenaed. And so I think within 2 to 3 years, quite a few of the funds that exist in this space will be facing criminal charges or forced shutdown due to things like MMPI. So again, I'm not saying there's a right answer. I'm not saying the MMPI program should look like Goldman Sachs or anything. But again, you would hope the manager's been at least thoughtful about this.
Steve.
Well, I would argue, to build on that, right? One question: have you gone through an SEC review? We've gone through 2, look, our business leads the FTX wind down. That's not just an SEC standard. That's a bankruptcy standard, and so having walls and MNPI, that's incredibly important in my opinion, and I totally agree with that. Coming to it a little bit differently, and I'll be brief because I know we're short on time. I do think it's the right time to don't spend a year on it, but develop a view that's clear about this space. And that doesn't mean defend all of crypto. That doesn't mean understand all of crypto. That doesn't mean get distracted by the different threads or the public things. But if you start with a clean slate today and you look at everything that's going on, it's very difficult, intellectually, honestly, in my opinion, to walk away from that exercise, whether it's real world assets, whether it's Bitcoin, whether it's Ethereum, whether it's the venture bet on the rails, whether it's DeFi. Develop a view about a few of those, and I think you will come to the conclusion that it makes some sense to have some exposure. The reason I say that is what I've observed over the last 7 years is you've gone through and this is partly crypto's fault, not just the allocator's fault. You've gone through this bizarre cyclicality of how allocators work, how fast crypto is, how noisy crypto is, and what ends up happening is everyone chases their own tail. They either make a bad investment at the wrong time or they don't get off of zero. And so at some point, it just needs to be looked through, and you need to say, I believe in what Ari said about real world assets. Yep. I believe in these 3 or 4 underlying assets. I believe that AI requires ZK proofs to be whatever the view is. You could come up with 10 or 15 of those, and then work backwards into who are the people that can express that view for you, and really try to crack through some of this, this haze of getting to one allocation in crypto, which is, it shouldn't be so all or nothing. We're talking about 1%. We're talking about 2% of your portfolio. But we spend so much time trying to disprove every piece of it, and it's just a bizarre waste of time, in my opinion.
Thanks, gentlemen. I would also just offer from my seat something that really everybody said in the spirit of this webinar is that this is a grow the pie time. And if you're talking to people that are incredibly non-transparent, do not want to collaborate with others, it's a bit of a red flag. We all have competitive products that are, could be looked at as substitutes for each other. But it would be very helpful for Arca, and I'm sure for Blocktower and Galaxy, the more successful each of us are. Back to Jeff's point, yes, we're the only person that could pass your due diligence. Wait, allocators don't really like a choice of one, and it's not really helpful. It would actually be constructive if there were 10 people on this call and a robust ecosystem of that. So look for people that like cooperating with other people, really like demonstrating what they're doing, because it's very hard to replicate. We could show you exactly what we do, but it's without tremendous resources and a lot of time, you're not going to be able to do it. Look for people that are very willing to explain to you what they're doing in very clear ways. All right, so we have some interesting questions that I think would be good for the whole group. Gentlemen, what do you think about Bitcoin DeFi narrative? And if anybody has strong thoughts on this, feel free to expand. I don't know if we need 3 different things on this, but does anybody have strong thoughts on Bitcoin DeFi narrative? So many hands.
I don't know if I have the strongest, but it seems like no one in the group has a really strong view. It's real. It's interesting. It is developing. There's been tremendous. I mean, you have the largest asset by market cap in crypto. You've a huge amount of value just in market cap and in real value that people hold that is sitting doing nothing. And so there's long been almost a desperation, right? People want yield. They want to get something more. And the impediment has historically been the technological infrastructure. We didn't have DeFi on Bitcoin, and that was due to a lack of programmability of the Bitcoin layer 1. The simplest mental model I have I'm not a technologist. I spend a lot of time trying to understand it as best I can, but this is a non-expert parroting experts here. It's Bitcoin's kind of Rube Goldberg machine. So things like Lightning Network are just immensely harder engineering projects than they would be on other chains, because you have a very limited programmability surface to kind of make, create those linkages. So that's gradually improving. People are kind of figuring out the Rube Goldbergs. We're building the infrastructure, and it is unlocking latent demand. So the demand is there. It's still early days. I do think there's some good trades and investments in that category, and it's pretty early days. So from like the VC side, I think there's good bets to make today over infrastructure built out over the next 3 to 5 years. And as a trader, it is an interesting place to look. I guess the big caveat I would add is it's early days on the tech. And so I expect they're, similar to the earliest days of DeFi, and frankly, it's still true for DeFi everywhere else. There's a lot of smart contract hacks. There's a lot of bugs. There's a lot of, most bridges in crypto broke over the last 3 years. That was any way to move an asset between 2 chains. A crazy amount of money was stolen and lost and hacked via those. So basically new tech is buggy, always, pretty much always, is a good assumption. So if you're going to store value in Bitcoin DeFi, understand this is a beta test. This is an experiment. This is not prime brokerage where I'm doing securities lending or harvesting. So like my own take has been, we looked at doing a Bitcoin yield fund 3 years ago. We decided there was demand. Like people wanted what we had to offer. We decided not to offer it because I would not have invested in the product. The best I could do 3 years ago was generating something like 2 or 3% yield on Bitcoin. And to do that would have required, in my view, taking more than 3% annualized risk. Basically, I felt those yield opportunities were negative expected value, and I didn't want to offer a product to the world that I thought was negative expected value. That's getting better. There are more yield opportunities. They're better. The tech is becoming a little more tested. My point, though, is you have to still view it as highly speculative. Don't put, don't think you're putting 20% of your AUM in Bitcoin yield farming and getting a marginal 10%. You're doing a very risky speculative exercise that requires a thorough risk underwriting.
Thanks, Ari. Gentlemen have to add something there, or? All right, here's a question that talks about the multiple geographies, and I think that can also lean into some of the things that we talked about, regulatory risk and how people think about that. And also just to add something that Ari said, a lot of these things are straight up criminal enterprises. I think investors got a very interesting and kind of rude awakening in something like the Telegram IPO, where just by investing in Telegram, they were found to be participating in the illegal distribution of securities. So there's this intersection between investing, regulation, and this idea where tech is very good at moving fast and breaking things. But when you're moving fast and breaking things in the financial service world, and when money is involved, the threshold of danger actually goes sometimes above just loss of capital. How do you guys think about regulatory risk in the way you proceed? Let's start with Steve.
Yeah, we've been ridiculously conservative. We're a public company. We're an RIA. We've got a broker dealer. It's just, again, you mentioned Goldman Sachs earlier. We actually cheekily tagged ourselves when we were first starting as we want to be the Goldman Sachs of crypto, and we meant that from the perspective of being the bridge between institutions and crypto, obviously. But we really meant, we're not going to cut any corners on anything like that, and we haven't. And so that's really hard because you actually leave a lot on the table commercially sometimes in the periods of euphoria. And so again, getting back to like the returns versus what you're actually solving for. And so I think the long-term view is the important one. The question, I think, was a little bit about coordinated exchanges. I mean, there can't be a global exchange when there isn't regulatory, either clarity or consistency. And so I actually think by the time you have a global crypto exchange that's integrated, you're going to have a global exchange where crypto and all assets and other digital assets are all collapsed into one anyway. And so that's an exciting thing to prepare for. But I think we're a ways away from that. And I think until we see a different SEC chairperson, we are going to stay in that mode and just, like I said, when we're talking to investors, it's the art of the possible. It's building products that are flexible by design so they can grow into the regulatory structures that exist. But I don't think there's a lot of appetite for any of us on this panel to go beyond that.
Okay. All right. In the interest of time, instead of ending on regulation, let's have just a closing thoughts from each of you guys. Let's try to keep it at about a minute, respectful of people's time. Ari, what would you like people to leave with from this call?
I'll use my minute to touch on that compliance question, and then
you can do whatever you want with it.
Second close off. So I think compliance is such a good example where it is so active today. It's not, oh, just follow best practice. So one example on this that I spent a lot of time thinking about for both strategic planning, active compliance, every angle is, so anyone who trades on DeFi today is probably committing a strict liability felony. Strict liability means intent does not matter at all. And that is if you trade on Uniswap, for example, and your counterparty for 0.1 ETH happens to be Lazarus Group, North Korea's OFAC blacklisted group, you're guilty of a strict felony under FinCEN and DOJ. That has nothing to do with the SEC. That is go to jail, do not pass go. There has not been a single enforcement of that, to my knowledge, to date, in a generic sense. I talked to DOJ about this. They're not intending to there's probably 5 million Americans who would be put in jail under that if they wanted to go fire and brimstone. They don't. They're not going to put 5 million people in jail. At some point, they will start enforcing that, and they'll do it probably in a spotty way, the way most enforcement happens. So that's an example where we and most regulated institutions knowingly took some tiny, tiny felony risk. And the alternative was don't be on DeFi at all. Don't ever trade on any permissionless DeFi, which is a pretty stark, which leaves you out of a good chunk of active management. It's totally viable. There's a lot you can do leaving that aside. So I can tell you our approach to this is it's a very ongoing active discussion with regulators. It's reading the tea leaves. It's trying to make prudent commercial decisions, all in the context that for me, at least personally, there's no amount of money you could pay me to spend a year in jail, which sounds like a contradiction, but like my own assessment was the odds of us being the first DOJ, basically, as soon as the DOJ brings their first case on enforcement or signals they're about to, we and a lot of our competitors that I talk to intend to, on that day, stop trading on DeFi. And we believe that reduces the risk of enforcement against us to near zero. So these are the kind of decisions that you have to navigate being in this industry as an active manager that are stressful, demanding, complex, nuanced, and as you can hear, a very different skill set than what you necessarily want from that first year analyst who's going to find the next meme. 5x for you.
100%. Steve, your minute. Go to jail or something else?
I mean, no interest in that. No, Sam already holds that mantle for crypto. We don't need any more of that. Now, look, I think the next phase of this is gonna disappoint a lot of crypto people in the sense that like crypto is gonna start to look more normal, which is there's a couple of different ways to think about that. All you really need to know is the top 10 asset managers are not just doing a Bitcoin fund. They all have a real strategy that's with the CEO that's about tokenization, it's about Ethereum, it's about active strategies. And so it's the boring papers that are going to be the allocation frameworks that come out. It's this stuff that just doesn't really excite crypto Twitter. It doesn't mean there's not going to be really deep, specific crypto native ideas that are interesting, but I think the next bull markets are gonna start to be about convergence. They're going to be about crossover strategies. They're going to be about allocation frameworks. The language is going to shift, and it's going to become more normalized in a very fast but not seemingly fast way. And you're going to wake up and say, "Wait a minute, how did that all happen?" And so there's still a little bit of confusion about that, which is to say there's more return to be taken out before that gets realized. So I think if you want to be fully de-risked, you can wait another year on that. If you want to take a little bit of risk to capture that spread in the world, understanding that, I think this next year is a really important time to get some chips on the table.
Great. Jeff, your thoughts?
Yeah, I mean, I think I 100% agree with what Steve just said, that traditional finance is creeping into digital assets in every way. What I want to do is kind of call back to something we talked about 30 minutes ago is sort of the preconceived notion and understanding what you're getting into. You know, a lot of what you hear about in digital assets is about Bitcoin or about Dogecoin or meme coins or some of the funny things that are enjoyable to write about and can get clicks, but don't really represent the entire industry. And what I always tell people is, you know, imagine if you were trying to invest in equities for the first time and all anybody told you about was like GameStop and Bed Bath and Beyond and AMC stock. Immediately you would say, well, this is not an investable asset class. I don't want to touch this. This makes no sense. It's all a joke. It's just people on Reddit driving something up for the fun of it. But that's not the case because equities have had such a 100-year history that you're able to compartmentalize the jokes and the memes and the weird things and treat that as different than what the asset class is. And the same thing is true of digital assets now. Whether you're investing yourself or talking to others about the space, inevitably they've heard of Dogecoin and Bitcoin, but that's not representative of where the investment opportunities are, where the risks are, where the different thought processes are that are going to move blockchain and investing in blockchain forward. So I would just caution everyone to take that same approach to compartmentalize the weird, the funny, the stories, and take a little bit of a deeper dive into why funds like Blocktower and Galaxy and Arca exist, because we really are taking this as serious as any other fiduciary responsibility in any other asset class, looking for areas of the world that are incredibly positively impacted by blockchain. And if we're right, you can make a lot of money by doing so.
Thanks, Jeff. And thanks, Ari, Steve, and Jeff for joining us today and being so open and sharing. Thought it was a great conversation. Everybody on the line, thanks for joining. There will be a replay for this. And also feel free to reach out to any of us to continue the conversation. So thank you so much for staying on a little over. Thanks, guys. Have a great day.
Thanks, everyone. Thanks for your time. Thanks, Ray.